Last month, there was an article in The Economist called "If You Thought the Global Financial Crisis Was Bad," written by short seller Carson Block. He surmised that within a few years, artificial intelligence will displace a significant portion of the world's highly paid knowledge workers. Aggregate demand will suffer, but flows into retirement investment accounts will turn net negative. Workers won't just stop paying in, they'll need to withdraw funds. These outflows will come largely from passive investment funds, particularly the S&P 500 index trackers. Although such redemptions involve selling every constituent in proportion to its index weight, the price impact will not be evenly distributed. The AI megacaps that have powered the index higher, such as Nvidia, Microsoft, and Amazon, are also the names whose valuations have been the most dependent upon mechanical passive inflows as the marginal buyer. The result, ironically, according to Block, is that the companies powering the AI revolution are likely to suffer the largest price drops. He went on to say that AI is at the inflection point at which large language models are improving at a rate that is nonlinear and will soon become exponential because they are themselves coding their own successors. The most sophisticated users of AI are in tech companies. Using the current generation of models, they have in many cases reduced teams that previously had a half dozen workers or more to just one. It's quite possible that within 3 to 4 years, AI will have replaced 15% of jobs in America's broader knowledge economy. Block noted that the two counterarguments are the Jevons paradox, which is the historical experience that new technology that increases efficiency also increases demand, thereby creating new jobs that offset the losses, and the skepticism about the slope of the adoption curve. He insisted that both will be proved wrong. He went on to say that humanity's ability to innovate and invent clearly outpaces its ability to adapt to its innovations and inventions. AI models are doubling in power roughly every 6 months. This means that workers made obsolete will not be able to develop the skills to use AI as a tool rather than to compete with it. Even if demand for services and products increases because of falling costs and prices, many displaced workers will still be obsolete, with more workers made so by successor model generations. AI will have such a profound impact on businesses' costs and pricing that failure to adopt quickly will prove existential for a large swath of the economy. The job displacement will fall disproportionately on highly educated, well-paid workers whose retirement savings drive America's stock markets. Michael Green of Simplify Asset Management has shown how passive investing has resulted in, quote, broken equity markets that are largely driven at an index level by inflows into retirement accounts. His and others' research highlights a weighty consequence of passive investing. Multipliers that cause the net inflow or outflow of $1 to have a much larger impact on the stocks in which it is invested, possibly as high as a multiple of 100 for the largest firms. Here's where it gets really interesting, and I confess that I have heard similar theories elsewhere. Block wrote that the S&P 500 has become an index that creates its own momentum for its largest constituents. Because the top 10 companies now represent an unprecedented share of the market's value, the index is no longer a diversified basket, but a concentrated volatility trap. When the professional class begins to draw down its accounts to service mortgages, the resulting market impact will be sudden and violent, as passive funds are forced to sell the index to meet the redemption demands of the displaced losers. Ironically, the companies with the highest multiples, which present the greatest risk from net outflows, are largely those that make up the AI stack. When the labor displacement thesis plays out, it will be the stock prices of those new world stars that get clobbered the hardest. The resulting crash in equity prices, particularly combined with falling aggregate demand, will itself be enough to cause a financial crisis on the scale of the global one that we experienced from 2007 to 2009, if not larger. Problems in private credit and insurance companies' balance sheets may well make things worse. A reduction in liquidity globally will affect all asset values. Deflationary pressures will mount. And here's where all of this leaves us. Block wrote that the good news is that the crisis of almost 20 years ago has given policymakers a well-tested playbook to restore liquidity and reflate assets. The bad news is that stabilizing the financial markets will be the easy bit for governments. They will struggle far more to manage the reordering of society that will result from the mass displacement of highly productive labor. Ultimately, in another irony, the AI revolution will lead to a world in which many consumers no longer have the income to participate in the revolution. Remaking a society in which growth has become decoupled from employment is a task for which today's political structures are not prepared. We will witness not just an almighty market correction, but the end of the existing social contract. That assessment is terrifying for most of us because the end of the existing social contract is something most people can't even fathom. I'm not sure I can. One thing I have said in the past is that optimism bias causes people to think they can deal with the challenges of the future simply because they were not undone by the challenges of the past. Friedrich Nietzsche once said that what doesn't kill you makes you stronger. Because people managed to survive past challenges like the global financial crisis and COVID, they might naively think they'll get through this one too. I hope they're right, but I fear that they are underestimating these risks simply because they can't fathom how much the world will have changed.